Imagine the year is 1987, a golden era of prosperity, excess, and, crucially, technology. The markets are on fire. The Dow Jones has climbed over 40% in 9 months. Everyone from Wall Street tycoons to small-town retirees sitting on a massive paper fortune. Wealth built on the fastest, smartest computers the world has ever seen. The arrogance is intoxicating. The system is, supposedly, unbreakable. Now, imagine this. In less time than it takes to fly coast to coast, that fortune, along with the wealth of every major investor, pension fund, and global bank, starts to vaporize. Not over weeks, not over days, but in 6 hours. On October 19th, 1987, a day known forever as Black Monday, $1 trillion, a figure that should have been mathematically impossible to lose in a single day, simply vanished. The system didn't slow down. It broke, shattered by its own programming. This is the story of Black Monday. A catastrophic flash crash that exposed the fatal flaw in Wall Street's shiny new toys and forced the Federal Reserve to risk everything in a desperate last-minute gamble to save global capitalism. This isn't just history. It's the chaotic, terrifying blueprint for every market crisis that followed. To understand the collapse, you have to understand the cocktail of confidence and complexity that preceded it. The 1980s were defined by deregulation and the rise of the computer. Before then, a crash took days, driven by human fear and paper trading. But in 1987, Wall Street introduced its ultimate weapon, portfolio insurance. It sounds comforting, right? Insurance. But this wasn't insurance. It was an algorithm, a cold, unblinking set of instructions programmed to sell stock futures automatically whenever the market dipped. Its purpose was to protect massive institutional portfolios without human emotion getting in the way. It was elegant. It was revolutionary. And it was universally adopted by the biggest players. Imagine a crowded theater where everyone has a fire escape plan. If the lights flicker, they all rush for the door simultaneously. Portfolio insurance was that plan. And in October 1987, all those millions of dollars of programmed instructions were pointed at the same fire escape. The cracks appeared the week before. Trade disputes with Germany, rising interest rates, and political instability were just the kindling. On the 14th and 16th, minor selling waves hit. The computers, doing exactly what they were programmed to do, responded by selling futures. The selling pressure bled over from the futures market to the stock market, triggering more selling, which triggered more computer sales. The feedback loop had begun, but nobody in New York was panicking yet. They just assumed the smart money. The algorithms knew something they didn't. But then came Monday, October 19th. The opening bell rings. Immediately, it's carnage. The Dow opens down 200 points. The computers are in a full-blown feeding frenzy, selling with inhuman speed and volume. The New York Stock Exchange floor is deafening, but the real action is happening silently. In the server rooms, where machines are desperately trying to find buyers for billions in futures contracts. By 1 p.m. Eastern, the market is down over 350 points. Banks stop trusting each other. Margin calls go out, hundreds of them, but the buyers are gone. The world's largest financial institutions are suddenly staring into a black hole of illiquidity. The Dow Jones Industrial Average is in free fall. When the closing bell mercifully rang, the index had lost 22.6% of its value. Not 2%, not 12%, 22.6%. The equivalent of an entire year of economic activity erased in a single trading day. The $1 trillion loss wasn't just a number. It was a global crisis of faith. The next morning, Tuesday, October 20th, the world wakes up, terrified that the banking system itself will seize up. Fear kills markets, but lack of liquidity kills banks. If banks stop lending to each other, if they refuse to honor payments, the entire system collapses like a house of cards. Enter Alan Greenspan, the newly appointed chairman of the Federal Reserve. He had less than 2 months on the job. The moment required a move so aggressive, so definitive, that it would override the panic. At 8:30 a.m., just hours before the market reopened, Greenspan issued a 2-sentence statement. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. It was the financial equivalent of a nuclear deterrent. It meant, simply, we will print and flood the system with unlimited cash to prevent a bank failure. They opened the spigots. They called every major bank CEO personally, not to ask, but to order them to lend money to the system's troubled players. The Fed became the market's buyer of last resort, flooding the system with the money it needed to breathe. It worked. The market remained volatile, but the systemic panic stopped. Greenspan had contained the crash, preventing a banking crisis that could have turned Black Monday into the next Great Depression. Black Monday was a crucial test. It taught us that when technology scales fear, the speed of collapse can outpace human reaction. It led directly to the creation of circuit breakers, automatic halts, in trading designed to give humans a chance to breathe and think before the algorithms kill us all. But the ghost of Black Monday still haunts us. In 2008, the crisis was slower, but the panic was the same. The need for a massive, centralized injection of liquidity, the Fed's emergency tool, was the lasting lesson taken from that terrifying day in 1987. The secret weapon behind this chaos, portfolio insurance, was built on sophisticated financial modeling, heavily influenced by the groundbreaking Black-Scholes options pricing model. This mathematical formula could calculate the theoretical value of a derivative, creating the illusion of scientific certainty in risk management. However, its genius concealed a fatal assumption. The model presumed there would always be a liquid market, that for every seller, a buyer would eventually materialize at some price. On Black Monday, this assumption evaporated. As automated programs unleashed a torrent of sell orders, the buyers vanished entirely. The algorithms, blind to the panic they were creating, just kept selling into an empty void, pushing prices down a spiral staircase with no bottom. The architects of these systems, brilliant academics and quantitative traders like Hayne Leland and Mark Rubenstein, believed they had created a perfect hedge. They had instead built a doomsday machine, and the biggest institutional players on Wall Street, from pension funds to investment banks, had all bought a ticket for the ride, exposing the entire financial system to a single point of failure. The contagion was global, and it began hours before Wall Street's opening bell. Thanks to the relentless march of time zones, Asia was the first to fall. The Hang Seng Index in Hong Kong was bludgeoned, and markets in Sydney and Tokyo felt the tremors, sending a wave of dread westward. By the time London opened, the FTSE 100 plunged, confirming that this was not a localized problem. The crisis also exposed the fragility of international economic cooperation. The Libre Accord, a recent agreement among G7 nations to stabilize the US dollar, was shattered. As capital fled to safety, the dollar's value gyrated wildly, proving that in a true panic, national self-interest instantly overrides coordinated policy. Each market's crash amplified the fear for the next one to open, creating a 24-hour cycle of doom that culminated in the New York meltdown. While algorithms executed the damage silently in server rooms, the human drama unfolded in sheer chaos on the floor of the New York Stock Exchange. Eyewitness accounts from traders describe a scene of pandemonium, a deafening roar of shouting and panic as mountains of paper sell orders rained down on trading posts. The floor's specialist system, where designated market makers were obligated to provide liquidity and maintain an orderly market, completely broke down. Specialists, who were supposed to buy when everyone else was selling, were instantly overwhelmed, their capital wiped out in minutes as they tried to absorb the unyielding tidal wave of sell orders. Simultaneously, the communication infrastructure bucked. Phone lines were jammed as brokers and banks frantically tried to reach each other to confirm trades or meet margin calls, effectively freezing parts of the system and amplifying the terror of uncertainty. The market wasn't just falling, it was disintegrating. Behind the scenes, in the marble halls of the Federal Reserve, a war room was forming around its new chairman, Alan Greenspan. A disciple of Ayn Rand, with a deep-seated faith in free markets, Greenspan was philosophically opposed to government intervention. Yet, he was staring at the abyss. In secret meetings with Treasury Secretary James Baker and the president of the New York Fed, Gerald Corrigan, Greenspan had to reconcile his ideology with the catastrophic reality. The decision was made to act decisively. His terse, two-sentence public statement was a masterclass in central bank communication. To the public it was reassuring. To the banks, it was an unambiguous command, backed by an implicit promise of unlimited firepower. The Fed was telling the market not only that it would provide liquidity, but that it expected the major banks to do their part and start lending again. The phone calls from the Fed to bank CEOs were not polite requests. They were orders to prevent the systemic collapse of capitalism itself. In the aftermath, the finger-pointing began. The Reagan administration quickly formed the Brady Commission, a presidential task force to dissect the crash. Its official report placed the blame squarely on program trading and the portfolio insurance strategies that had created the vicious feedback loop. This led to a major legislative response, TRDO, of circuit breakers. These automatic trading halts, which are now standard in global markets, were designed as a mandatory timeout. a way to force a pause in the algorithmic carnage and allow human reason to re-enter the equation. The debate raged. Did the Fed's intervention constitute a bailout for reckless Wall Street gamblers, setting a dangerous precedent of moral hazard, or was it a necessary, life-saving measure to protect the entire economic system from the brink of a second Great Depression? The consensus landed on the latter, establishing a playbook that would be used again. The crash ignited a deep philosophical debate about the very nature of markets. Was the market an efficient system of rational actors, as the dominant, efficient market hypothesis suggested, or was it better described by the fractal market hypothesis, which allows for herd behavior, panic, and chaotic, unpredictable swings? Black Monday was a brutal real-world vote for the latter. It was a terrifying case study in collective panic, where rational, self-interested decision selling to protect a portfolio combined to create a collectively irrational and suicidal outcome. The event also revealed a fundamental paradox of modern finance. Technology designed to make markets faster and more efficient also makes crises faster and more severe. The speed of the 1987 crash was its defining feature, a warning that our ability to innovate can easily outstrip our ability to control the consequences. The echoes of Black Monday are undeniable. The playbook, written by Greenspan in 1987, intervened early, massively, and with overwhelming force to provide liquidity, became the blueprint for the 2008 financial crisis. Federal Reserve Chairman Ben Bernanke's response to the collapse of Lehman Brothers was a direct descendant of the 1987 intervention, only on a vastly larger scale, and the threat of algorithmic trading has not disappeared. It has only evolved. The 2010 flash crash, where the Dow plunged nearly 1,000 points in minutes due to a rogue algorithm, was a stark reminder that the ghost in the machine is still with us. Ultimately, Black Monday represents a watershed moment in financial history. It was the day the machines first proved they could take control of the world's money, and it forever changed the role of central banks into the ultimate guarantors against our own technological creations.